In this episode, I want to give my opinion on the Chinese stock market. There's been a lot of media attention and focus on China in the past few weeks due to recent IPOs, politics, and various other financial news. Now, I'm going to lay out how I see China from an investing stance. As I mentioned, there's a lot of talk at the moment over how Chinese stocks are making massive moves. Alibaba in particular has fallen to rock bottom bargain bin prices due to the actions of the People's Republic of China, the PRC. Now they are responding to Jack Ma's media comments, and I'll go into that more later. Evergrande has had some massive media attention lately due to defaulting on an interest payment for their $300 billion debt. Now I've noticed that a number of YouTube investor channels are promoting cheap Chinese companies based largely on fundamentals and articles they've read online. Unfortunately, I think this may be setting some sheep traders up with some value traps. This is a shame, as a simple SWOT analysis would offer some insight into the situation, and that's where you compare the strengths, the weaknesses, the opportunities and the threats. Let's start with the strengths. The Chinese stock market is fairly young compared to the 229-year-old US market, having been closed since 1949 when the Communist Party took power, only to reopen in 1990. The Chinese markets pale in comparison to more established exchanges such as the USA if you compare the value and number of companies, but the markets have shown consistent growth. Now, since coming to power, Xi Jinping has focused on economic reform, deepening the country's financial markets, utilizing them for greater financial investments. This is all to create the Chinese dream, and Chinese equities have seen some quite outstanding peaks over the past few years. Now, as for opportunities, there are many. China has for years been the main producer of so many products for the rest of the world. But this has been a major issue for the Trump administration. The country has a reputation of stealing intellectual property from the very companies they work with. From their counterfeit versions of iPhones to software, trade secrets. China's stance is essentially that if countries want access to a population of 1.44 billion people, larger than many of the world's biggest countries put together, then they have to hand over key technologies just to enter the market. This is a huge price to pay, especially when the country then uses that intellectual property to matchmake, making their own competing versions of the same products. The Commission on the Theft of American Intellectual Property said that China is deeply committed to industrial policies that include maximizing the acquisition of foreign technology and information, policies that have contributed to greater IP theft. The report estimated that this issue cost the US economy around $225 to $600 billion annually. In 2019, Tesla filed a lawsuit against one of their former autopilot engineers, Ganji Zhao, claiming he downloaded the autopilot source code before he left their company and sold it to XPeng when he joined their company. You just have to compare XPeng's website to Tesla's to see how heavily their lineup replicates Tesla and why they would be so interested in any Tesla technology. Still, none of this copying has prevented their share price from climbing higher. Still, when companies are prepared to mimic their American counterparts, it does prevent an opportunity for investors to enter on the ground floor and potentially reap huge rewards if they are successful. Imitation is the best form of flattery after all. But there are weaknesses in Chinese investments. The reason you don't see Chinese companies listed directly on Western exchanges is that the Chinese government limits foreign investments to a select few qualified foreign institutional investors, or QFIIs. Some of which can then list Chinese securities as American Depository Receipts, ADRs, where they effectively own the stock in your behalf in your name. Now, ADRs aren't necessarily so different from how trading apps hold stocks on behalf of their customers, but compared to traditional listings, investors will typically not have the same amount of company information available to them, and due to how they are issued, they can inherit risks from the exchange rates, political changes, and inflation. Now, for any company to enter the more open Western markets, they have to meet certain regulatory requirements that require an in-depth look at the company's financials and procedures. It might be a pain for companies to justify and release their financials and business practices via forms such as the S1, but this check provides sufficient information for the exchange and potential investors to make an informed and correct decision. This safeguard protects investors and the credibility of the exchange. Now, without the checks and balances that come from regulated exchanges, some Chinese companies have managed to pull the wool over investors' eyes. The Chinese company Luckin Coffee aimed to be a Starbucks beater and boasted a business model of using modern technology to offer a streamlined service for customers. They promoted their services through celebrity endorsements and offered a free coffee to all customers who installed their app. The business produced positive numbers on customer volume with financials to match. The stock was on a rocket to the moon, that is, until a short seller pointed out that after studying the volume of customers physically entering their sites and calculating the coffee pricing against volume for each store, the resulting sales figures didn't add up. They were far below what the company were reporting. Once the news spread, the stock tanked and investors were burned in all markets.
Luckin really came to the market, got a bunch of capital from its IPO, and then just sort of left. And it left a lot of American investors like holding the bag.
This type of dishonest behavior isn't unique to China, and there are plenty of American examples. Theranos, Nikola, for example. But there is something to be said about the dangers of buying into the promises of immoral CEOs or not having factual information on company operations, which is clearly an issue when it comes to Chinese companies. The shocking situation with Evergrande could have been avoided according to Andrew Left, a short seller who raised the alarm on the company back in as early as 2012, when his short seller report predicted the company would soon be insolvent due to how they were playing fast and loose with debt and using aggressive accounting to masquerade its true financial health. Rather than take him seriously, the Hong Kong Securities and Futures Commission, the SFC, accused him of using false and misleading information. They sued him, but the 2015 tribunal wouldn't let him produce records and documents as evidence. He was eventually banned from trading on the Hong Kong markets for 5 years. 10 years on, and not only has he been proven correct, but the damage has escalated to a level severely damaging to Evergrande, along with the country, and likely to have worldwide repercussions. Now, the Chinese market isn't all bad. Innovative companies such as Alibaba and TikTok have proven that they can do exceptionally well and shown that companies on the Chinese markets can equal or even exceed those in the USA. So if there's money to be made and Alibaba is apparently trading at undervalued levels, then why not invest? Unfortunately, the water is very murky here, as the threats I'm talking about, the threats to investors, extend far beyond the financials, as there is the political and social element that needs to be considered. Now lately, relations between USA and China are worsening and have become far more complicated. China is seen as not just a competitor to US market dominance, but also a competitor in the types of values the countries hold. When issues extend beyond business, things become far more complex and difficult to predict. Now, Hong Kong in particular has benefited from a special financial status in terms of the stock market. But after China invaded, and yes, I said invaded, they forced the country to abide by their national security law that the people never supported. This eroded their autonomy and forced the Trump administration to remove their special status, effectively treating them as the rest of China. When Xi Jinping came to power, he declared himself the sole leader of the People's Republic of China, doing away with the collective leadership. He appointed himself General Secretary of the Communist Party, Chair of the Military Commission, along with the head of bodies overseeing the Internet, government restructuring, national security and military reform, and has effectively taken over the courts, the police, the secret police, He's additionally removed any opposition from the party, claiming he was removing corruption, and eliminated term limits, meaning he could effectively rule for life, while simultaneously demanding loyalty pledges from all members of the government and beyond. Now, there are some simple steps to building tyrannical totalitarian regimes. Keep your people ignorant, keep them poor, keep them weak. He's done this by banning reading material that doesn't conform to the National Party's ideals, implementing laws to crush any rights to freedom, laws on how much time children can play computer games, bans on karaoke songs, strict rules on how celebrities can behave, banning any criticism of the government, all to enforce the notion that any criticism of the Chinese government is an insult to the Chinese people. He's targeted the rich and anyone who he deems to have too much media influence. The PRC even banned Winnie the Pooh after comparisons to President Xi.
Oh yes, I'm rumbly in my tumbly.
The recent and sudden ban on digital currency is just part of the attack against Chinese people having any financial freedoms. Jack Ma spoke negatively about the party, and as punishment, on the eve of Ant Group's IPO, Xi Jinping personally scuttled the process. Jack Ma disappeared from public view for some time, with many fears of his welfare. The company is now being converted into a financial holding company controlled by the Chinese state bank. Whereas Jack Ma resisted the government's insistence on him sharing data on what his Alipay customers were spending money on, I doubt the state bank will be so withholding. It's of no surprise that Alibaba stock has been on a downward trend ever since. Didi was China's version of Uber, who entered New York Stock Exchange in June. Within days of the IPO, in which they raised $4.4 billion, and without warning, the Cyberspace Administration of China started a crackdown on the company, citing violations in collection and usage of personal information. They fined Didi under anti-monopoly laws, they ordered all Didi apps to be removed from the stores, and they sent state security and police to Didi headquarters as part of the investigation. Didi stock tanked over 25%, and the US Securities and Exchange Commissions had to put a halt on Chinese IPOs due to concerns over their accordance to regulations. Now, the PRC has made it clear that Chinese companies seeking to raise capital on foreign exchanges will be brought in line.
They don't want our money. It seems like they want to destroy American stocks now.
And for companies taking their business to China, well, look at none other than Tesla. Tesla thought they hit the jackpot when the PRC allowed them to open up a gigafactory in China, in record speed and with firm support from the Chinese government. The deal raised the bar for electric vehicles in China, but when relations with the West deteriorated, it didn't take them long to turn on Elon, with the PRC demanding increasingly stringent regulations, particularly against non-Chinese companies, namely Tesla, forcing the firm to issue recalls on all their vehicles for software updates, along with numerous public apologies that has cost the brand credibility in the country. Footage of a protester standing on a Tesla during the Shanghai Auto Show has been spread online globally. The protester alleged that her father's Tesla had faulty brakes, resulting in his crash. Tesla has released data that showed that not only the driver was heavily speeding at the time, but had used the brakes 40 times within the half hour of the crash. The protester insisted that the data was falsified and demanded her money back, whereas Tesla felt her demands were unreasonable. Tesla then felt the weight of the Chinese government via the Central Political and Legal Affairs Commission of the Communist Party of China, who cited Tesla for a lack of effort in finding causes of problems, improving features, or respecting Chinese consumers, and failing to comply with local laws and regulations. Tesla was forced to publicly apologize for not addressing customers' complaints in a timely manner. I'm not arguing on whether Tesla handled the situation as well as they could, but it's how quickly the Chinese government was prepared to come down on Tesla without reviewing the evidence. Although they are the country's #1 seller of electric vehicles, customer sentiment towards the brand is souring for their perceived arrogance towards their customers, and any major brand knows that reputation is their valuable asset. Sales data suggests that sales from local brands are quickly catching up. Now I've put a link in the description for a video giving more details on this particular story. When a market is so tightly influenced by their government, then their motives need to be questioned. The PRC under Xi Jinping is a government willing to cut off their nose to spite their face. Their ethics need to be questioned when they set up concentration camps for forced re-education, forced sterilization of ethnic minorities, expelling and imprisoning their own politicians and journalists for exposing these actions or standing up for basic human rights. The PRC are willing to sacrifice freedom, crush dissidents, commit genocide, imprison their critics, because they consider this an acceptable price to pay to achieve the Chinese dream, and the people should be grateful for the privileges of living under the regime. Make no mistake, Xi Jinping has led the PRC with principles extracted from Maoism, Marxism and Nazism. Don't think the PRC care about Western opinion. John Adams, US President from 1797 to 1801, once said, "There are two ways to conquer and enslave a country. One is by the sword, the other is by debt." World reliance on China for production has allowed them to use debt-trap diplomacy in achieving their goals and escaping the consequences. Now, Warren Buffett has talked about the value of ethical investing. With the newspaper test, he asked one question: would you make a decision if you knew the result would appear in the newspaper the following day? Guy Spear wrote about Buffett's sense of moral excellence in his book, The Education of a Value Investor. He spoke on how Buffett focuses on his inner scorecard, on how he feels about the decisions he makes and his ability to live with those decisions. Cathie Wood bought into a number of Chinese stocks, and looking at Tencent for example, on August 16th she dumped 171,000 shares after China's tech crackdown, then bought up almost 235,000 only 9 days later and held on to them just long enough to see them crash again. For someone so focused on innovation, she ignored the ethical side of the equation, and the results have presented a buy high, sell low strategy, and ARK has wiped out their 2021 gains already. And the majority of her losses were outshined by Tesla's growth. So when you see Chinese stocks going irresistibly cheap, do not be fooled. These are entries into a fascist regime, a market tightly controlled by the Chinese state, spreading tyranny to its people and the world. Don't be fooled by attractive financials, as Chinese ADRs are risky, and if you go looking for bargains, you may find yourself looking into a value trap, staring at red charts. Now, if you're looking for investments outside of your own country, then perhaps look to Europe. There are many stocks in Germany, France, Spain and the UK that have been overlooked. Even bigger brands such as Volkswagen are trading cheap considering their earnings and dividends. Countries with good moral standards and freedoms are ready to be traded with and offer far more stability and fairness in their markets. I think there is a benefit to distributing a portfolio in several currencies and exchanges, and the euro and pound are not bad choices. So that's my take on the Chinese market. Do you agree? Well, by all means comment below and let me know. And if you like what you see and you want to see more, please consider subscribing. Until next time.
Winnie the Pooh, Winnie the Pooh, chubby little fluffy, all stuffed with fluff. He's Winnie the Pooh, Winnie the Pooh, willy-nilly, silly,